Hello everyone, welcome back to this channel. Today we have an exciting topic to discuss that bridges two worlds, the world of retail investors and the world of companies looking to raise capital. In this video we'll explore the ins and outs of the IPOs or initial public offerings from both the perspective of retail investors and issuing companies. So let's get started. In simple language, an IPO stands for initial public offering. It's when a private company decides to become public company by offering its shares to general public for the first time. This means that regular people like you and me can buy a piece of that company by purchasing its shares. The company does this to raise money from investors, and in return the investors become partial owners of that company. For retail investors, an IPO represents an opportunity to be a part of a company's journey from a private entity to publicly traded one. Let's see the pros and cons of investing in IPO. On the one hand, investors may have a chance to buy shares at offering price before they start trading on the open market, potentially leading to early gains. On the other hand, there could be risks involved, such as the stock price dropping right after the IPO. Before jumping into any IPO, it's important for retail investors to do their homework, research the company's financial management team, competitive landscape, and overall growth prospects. This information will help make informed investment decisions. Now let's see things from the issuing company's perspective. Why would a private company want to go public? Well, there are several reasons. One of the primary reasons is to raise capital. Going public allows the company to raise funds from a wide range of investors, which can be used for expansion, research, product development, and many more. By going public, early investors and founders who hold shares can now sell their holdings on the open market, providing them with the liquidity and a chance to realize their gains. Now let's walk through the process of company filing an IPO. First step is hiring underwriters. The issuing company hires underwriters who are investment banks responsible for facilitating the IPO process and finding buyers for the shares. Second is preparing prospectus or DRHP, which is draft red herring prospectus. The company drafts a prospectus, a detailed document that provides information about the company, its financials, risk, and other relevant details. Third is getting approval from regulators. The prospectus is then filed with the appropriate regulatory bodies such as SEC in the USA or Securities and Exchange Board, which is SEBI in India. These regulators review the filing and must approve it before the IPO can proceed. And the last and fourth step is roadshow and pricing. During the roadshow, company executives and underwriters presents the IPO to potential investors. Based on demand, the underwriters determine the IPO's final offering price. So to conclude this video, we did a comprehensive explanation of IPOs from both the retail investors' perspective and issuing company's perspective, and the process of company filing an IPO. Remember, investing always carries a risk. So do your research, seek advice if needed, and make informed decisions. If you enjoyed this video and found it informative, give it a like and subscribe to this channel for more videos like this. If you have any questions or want to share your experiences with IPOs, leave them in the comment box below. Thank you for watching. Until the next time.